Let's kick off with Mike Muller, head of Vitol in Asia. Mike, your thoughts and takeaways from an oil market perspective through the month of January?
Yes, I think risk premium is certainly the big debate here. I mean, it's been absolutely an avalanche of headlines. The much expected retaliation by the US, by the Biden administration. Biden, of course, under terrific political pressure in an election year, manifested itself in attacks on Syrian and Iraqi soil in terms of targets of allegedly Iranian-backed military capabilities in those areas, was followed up by attacks on Yemen yesterday, and it seems to be ongoing again today. This obviously has happened whilst markets are closed. On Friday, Brent sagged into the high 70s. We had made a high of $84.80, I think, basis Brent. So a lot of risk premium had come out of the market, but we have a market that is having to come to grips with things it didn't expect. I mean, the porosity of air defenses, for example, not just the capabilities in the Bab el-Mandeb area and the Gulf of Aden, but also in Russia have come to the fore in terms of attacks being possible on a refinery in Volgograd, which is 600 kilometers into Russia, and on energy infrastructure in Ust-Luga, which is St. Petersburg, which is a long, long way from Ukraine. And then, of course, the very graphic pictures of ships being hit by Houthi projectiles in the Gulf of Aden, quite far from the Bab el-Mandeb itself, of course, just reminding us all of the fact that the naval defenses in that area cannot cover the entire stretch of the ocean. And then the Houthis announcing that the arena was going to be expanded to the Middle East Gulf, and indeed the need for missiles to be intercepted en route to Eilat in southern Israel. The arena is very quickly spreading, and it's understandable, of course, that you get voices of concern in the US, in Brussels, about the risk of further escalation. And it was highly predictable, of course, that the US strikes would never touch Iran itself. But there was a lot of concern in the market, and the oil price does not necessarily reflect that. There have been many comments on social media and on the news about how actual oil producing capability has not been affected, but refined product capability has certainly been hit in Russia. And whilst the Russian headlines are that the Volgograd refinery is operating just fine, photographs of units on fire at night would suggest that maybe the hit was pretty much a direct one. And as for the navigability of the Bab el-Mandeb, we are seeing way more ships taking the long route around the Cape and avoiding passage in that area than most people would have expected 2 weeks ago. And that's clearly put a big risk premium into clean products markets in particular, and less so dirty. But shipping rates, of course, are reflecting that. We're seeing commensurate stock builds on water, and we're seeing some elevated concern, and therefore reactions in differentials of products markets that reflect that. The best graphic example would be distillate east-west markets, which had to reprice quite markedly middle of last week, or early last week, in fact, to ensure that any potential surplus of distillates building in Asia would be able to afford to make its way around the Cape on the longer route to get to Western markets.
Mike, much of January we saw obviously this disruption grow. As you said, you couldn't have imagined, the market imagined 2 weeks ago, the scale of disruption that is now redirecting ships and so forth. The big sort of story in a way through January, although a risk premium did grow into the price, was how unaffected the oil markets were through this fairly significant crisis in terms of at least the front end of the oil price. So, Mike, what other areas did this disruption, or did the Red Sea, how does it impact the oil markets? There's some reporting that it's sort of impacting the possibility of sort of geographically redirecting flows, that the amount of crude and products that was moving east to west and west to east is now not, and that markets are localizing. Just want to get your thoughts on that, Mike, and other impacts that this disruption at the Red Sea is having.
Yes, we need to look at trade flows that typically transit the Red Sea. The most graphic one was that naphtha tanker, which was ablaze and Everyone has pictures in their minds of that, of course. Naphtha is short in Asia and long in the West. This particular tanker was carrying naphtha from a Black Sea Russian refinery. But there are many other flows of naphtha from North Africa, from the Mediterranean, from Europe that come through the Suez Canal to Asia. So naphtha was, unsurprisingly, the first market that got very jumpy when the Houthis first disrupted shipping traffic. We had a view that several tanker owners were still willing to transit, and therefore the market had factored in a certain amount of disruption where some responsible owners and oil majors had declared pretty much on day one they would no longer try and transit the Red Sea. For the most part, the ships would. As we saw this particular attack, a very large percentage of tankers carrying naphtha, hoping to transit the Red Sea, turned around. And that trade flow has definitely created a much stronger Asian naphtha market as a consequence. If you look at the second product that moves west to east, it's fuel. This was less impacted, but it was a Russian cargo of fuel that was hit by the Houthis, which came just days after the Houthis made it clear that they would be avoiding Russian and Chinese targets. And therefore that highlighted to everybody that maybe the ability to verify which ship was which was perhaps a little bit unclear also. And suddenly that meant that every tanker was at risk, rather than just tankers that had a Israeli, British, European or US nexus. Then you look at flows going the other way. There was a structural flow of jet fuel and diesel in particular out of Middle Eastern and Indian refineries that go to Europe. And a lot of that is staple trade for the likes of Kuwait Petroleum Company, for example. And the other big flow that goes north through Suez Canal is LNG, best illustrated by Qatari LNG heading to Western markets. There was a lot of watching out to see whether these GCC producers and the Indians would take a view that transiting the Red Sea was still a possibility. And over the weeks that we've seen, there's been a decided decision making that these ships should go around the bottom. Now, that was expected to spook LNG markets. I mentioned the impact on the East-West diesel spread a few minutes ago, but for not boost LNG shipping rates to a point where the Qataris and others from Asia can afford to put their ships from the bottom of Africa, which is what we're seeing. So I can go on and on, Sean, but the main impact so far on clean shipping rates, because the number of ton miles added is massive, and you can see it in international stock data. Stocks of diesel on the water have gone up markedly in the last 2 weeks, as you see diesel flows taking the long route.
Well, if you just to follow up on that, Mike, as my earlier point, and what we saw on Friday, the drop in the markets based on reporting that there might be some ceasefire in Gaza, does that seem justified to you from the point of view of the market disruption is now possibly going to be removed?
You broke up a little bit, but I think the market had issues with the credibility of those headlines, because the suddenness of the alleged readiness of the Israelis and Hamas to call a ceasefire and thereby take away the reasons for the Houthis to continue blocking the Red Sea passage seemed a little bit hard to believe, and therefore the market needed to see a little bit more verification of that. And for my part, I've yet to see that, so I don't think the market's taken that all that seriously yet.
Looking out, obviously, this is early February. This is the month of the China New Year, which is on the 10th of February. Millions, hundreds of millions of Chinese on the move. What's your outlook month ahead? How big is the China piece to that?
We're already tracking Chinese statistics for we call the big New Year migration, and the market is expecting a record, more than pre-COVID, more than 2019. But it's manifesting itself in slightly different ways.
More being more people traveling, more being.
Yes, absolutely. More bumps on passenger seats, but for the most part, more traveling. Chinese motor vehicle ownership has gone up quite dramatically since before COVID. So we're expecting private passenger trips to be way off the top of the precedent, but domestic air travel is also expected to be at all-time highs. The only piece in the jigsaw of demand that's missing is still international travel. So your international Chinese tourist is still very much lacking. But yes, China is expected to post big numbers, and even though the Chinese manufacturing indices have still been languishing at slightly below the 50 mark, they're not going into negative territory too badly. So, I mean, along with the bionic US jobs data, as you so nicely put it, Sean, the tech stocks performing incredibly well. Oil majors coming in better than expected results. Those manufacturing indices, not just in China, but all around the world, outperforming. And China evidently trying to stimulate its way out of trouble. The world's looking a lot more upbeat, so much so that I sense that the consensus of consultants and forecasting firms out there is revising demand growth up. I know that Christoph said before that the oil markets tend to respond somewhat glacially, but I think certainly in my little corner of the world in Asia, there's a view that demand estimates will need to be revised up somewhat, which with the price.
Well, at the moment, demand growth is about 1.5 consensus million barrels a day for 2024. You're suggesting that might need to be increased?
Yeah, I think the consensus is between the 1.5 and 1.7 range, and I think some people are talking it could be 1.8. That, of course, makes OPEC's tasks a lot easier, not least coming off the back of a month which put in your pre-read, Sean, where the month of January was a lower output month for OPEC, helped a little by the problems in Libya, of course, but there seems to be general discipline and restraint there also.
Well, Mike, just a last word on that from a supply side. We've talked a lot about on the demand side through our half hour together, but just picking up on Christoph, although that supply side story from Saudi was 27 million barrels of extra capacity. The current outlook for the year ahead, you mentioned earlier in your comment that anything above 1.5, 1.7 would be good for OPEC plus. But nonetheless, there are a lot of new supply still coming from non-OPEC plus. Your thoughts from the supply side going forward? Does it continue to be a dampening for prices more in the 70s than in the 80s? Your thoughts?
We can't get away from the fact that there is spare capacity in the market today, and that OPEC Plus have the handle on that, and therefore OPEC Plus cohesion keeps the price pretty much where they want. And I think this current plus minus around the 80 mark is pretty much where a level they're happy with. So as long as the wheels don't come off the OPEC Plus juggernaut, I think the extra demand we talked about earlier plays into the hands somewhat. I think that makes for a reasonably predictable task for OPEC Plus going forward.
Just on top of that, Mike, I mean, we have the Russian barrels last year into Asia at a discounted level. We have the Iranian barrels into China also discounted. Do they also need to continue at the same levels as last year in order for this market to be sort of in the balanced space where you're articulating?
Yeah, of course.
I think of everyone's supply demand balances are assuming what you say there, Sean, and Christopher's already the answer is of course. I mean, there's a bit of color around Venezuela. Of course, Venezuela is not sanctioned at the moment, but General License 44 lapses in April. And there have been noises from the White House that they might allow it to lapse if they're not happy with the democratic messaging coming out of Caracas. We have to be very careful to use that with Venezuelan oil disappearing. It will simply go back into the hands of those channels that bring it to market in a roundabout ways.